Welcome to the deep dive. Today we're tackling a really complex set of sources you sent over. They connect things you might not normally put together. Federal housing policy, global finance, even the psychology of making deals in real estate. We're going deep into what really drives wealth and, frankly, control in this space.
That's a great way to put it. The material really does synthesize these fields. And our mission here, I think, is to get past the usual buy low, sell high talk. We want to explore the, let's call them hidden levers. How big systemic decisions, sometimes murky financial structures, and focused individual actions all weave together. That intersection is where property ownership really creates or transfers wealth.
Exactly. And we're going to start big picture, almost uncomfortably so. We'll lay out how the housing map in America wasn't accidental. It was, well, intentionally shaped by policy, designed, really, to benefit certain groups. Then we'll shift gears into the finance side, the complex risks and scaling, looking hard at the 2007 meltdown, and also what's happening now with PropTech, this digitization push. And finally, we'll drill down, get really granular on the actual tactics, the strategies successful investors and agents use day to day.
Okay, so to really get the modern picture of wealth and where it sits geographically in the U.S., we absolutely have to start with a difficult historical truth. Your sources confirm this clearly. Racial segregation in housing, it wasn't just, private biases playing out. It was actually a formal, deliberate government project, policy, known as de jure segregation.
That's such a critical distinction because it means we have to see federal agencies not as neutral referees, but as actor-designers of inequality, especially after World War II. The sources really spotlight the Federal Housing Administration, the FHA, and the VA, too. I mean, by 1950, weren't they insuring something like half of all new mortgages?
That's right, half, nationwide. So their policies essentially decided where the money flowed, where investment happened.
And that flow had clear directions, didn't it? Based on race.
Explicitly. The FHA's own underwriting manual basically became the rule book for systemic exclusion, what people commonly call redlining. The manual assigned risk ratings to whole neighborhoods. And if a community was African American or even just integrated,
it was deemed high risk.
High risk, automatically, effectively ineligible for those crucial federally insured mortgages. This just cut off the capital supply to those areas.
And it wasn't just about not insuring loans in certain areas, was it? They actively promoted segregation in the new white suburbs that were booming.
Oh, absolutely. The sources emphasize the FHA often required the use of restrictive covenants.
Restrictive covenants. Can you quickly define that for anyone listening?
Sure. It's a clause, a legal clause, written directly into the deed of the property. A binding legal thing that explicitly prohibited the owner from ever selling or even leasing the property to non-white people.
And the FHA demanded these?
Frequently, yes. It was often a non-negotiable condition for getting mortgage insurance in those new white suburban developments. It wasn't hidden. It was an open government requirement. Keep the neighborhood racially uniform if you want the security of a federally backed loan.
The long-term economic fallout from that kind of engineered exclusion, it's just staggering. And we still feel it today, right? It wasn't just about where people lived.
No, it was fundamentally about wealth separation. The government effectively locked Black families out of the single biggest wealth-building engine of the mid-20th century.
Which was subsidized homeownership, low interest rates, government backing.
Precisely. Couple that with other policies that sources show intentionally kept African-American wages down and forced higher expenses in those underfunded neighborhoods. It just compounded. Black families had less disposable income, way fewer savings. They were denied the very tool that was creating generational wealth for white Americans during that huge post-war expansion. The sources are very clear. Today's wealth gap is directly tied to those historical policy choices.
And at the same time, working on a more local level, there was another powerful tool being used. Zoning laws. They seem kind of mundane, right? Just deciding where a factory can go versus houses.
Yeah.
But they became a really effective way to separate people economically and often racially, too.
Yeah, zoning gave municipalities huge control over land use, everything from building height, density, lot size, you name it. The sources describe this evolution of zoning as, and this is a striking phrase, a kind of local immigration law.
How so?
Well, think about it. If a town mandates that every single house has to be on a minimum 2-acre lot and maybe have a minimum square footage of 3,000 square feet.
Yeah, right. That immediately sets a really high price floor for any housing there.
Exactly. It becomes a gatekeeper. It favors the insiders, the people who already own property and can handle the high property taxes. And it effectively locks out outsiders, people who might want to move there but just can't afford that artificially high entry point, regardless of their race.
So it segregates by class, which, given the historical context we just discussed, often ends up correlating strongly with race.
Precisely. It perpetuates inequality by manipulating the supply and the cost of housing in the most desirable areas. It's a key structural thing that still makes building affordable housing incredibly difficult and keeps property values concentrated in exclusive places. Hashtag tagged hashtag 1.2 governance, power, and public works.
Okay, so this systematic control, whether it's federal rules or local zoning, it really shows how the physical landscape gets shaped, not just by market forces, but by powerful figures using government tools. And when you talk about that kind of power in American history, the sources point directly to one figure, Robert Moses.
Ah, Moses. Yeah, his story is absolutely crucial here because he didn't just play the political game well. He fundamentally restructured how power worked, at least in New York. He brilliantly centralized forces, money, contracts, commissions that technically weren't supposed to drive political decisions. He did it through managing enormous public works projects. What's really fascinating, according to the sources, is how he sort of sanitized corruption. He replaced the old model of illegal payoffs, graft.
Right, just bribing politicians.
Yeah, he replaced that with a system of legal benefits for all the key political stakeholders.
So political leaders, the construction industry, the bond markets, the heads of his commissions, they all got tangible, legal, structural advantages from his projects.
Exactly. And that ensured their loyalty, their ongoing support, that collective weight from dozens of politically powerful people and groups all depending on Moses to keep the projects flowing and the money moving. It became a force that no single elected official, not even the mayor or the governor, could really stand up against for long. His power wasn't really democratic. It was structural. It was financial. He controlled the blueprints, the budgets, the jobs.
And the sources detail just how ambitious he was using this centralized power. Can you give us a sense of the scale? What kind of assets did he actually control or influence?
Oh, the scale was immense. One incredible example showing his influence over policy was how he basically quadrupled state park acreage on Long Island in one go. He did it by using his political clout, specifically getting President Hoover, Herbert Hoover, to release a huge chunk of Fire Island Coast Guard land for park use. That's linking local ambition with federal power. Another key maneuver, with Governor Al Smith's help, was getting what's called a surface easement from New York City. This gave him control over 3,500 acres of incredibly valuable watershed properties. He ended up wielding control over vital land and resources that went way beyond any official title he held.
And these historical actions, building bridges low enough to keep buses out, highways that literally cut through an isolated, poor minority neighborhoods from wealthier suburbs, they really laid the groundwork for the urban divisions we still see today, don't they?
Oh, absolutely. That historical context directly sets the stage for the persistent pattern in the U.S. where, status and income are still strongly linked to suburban living. The sources actually give us hard data on this widening gap.
And it wasn't just a static gap, it was growing.
It was accelerating, yeah. Between 1970 and 1983, the difference between the median income in central cities and their surrounding suburbs grew significantly. In 1970, city median household income was about 80% of the suburban level. By 83, it had dropped to just 72%. Those physical decisions, those political power plays made decades ago by figures like Moses, they're still shaping economic realities and property values right now. It's a tangible legacy of policy and power.
Okay, let's pivot now from policy and physical structures more towards finance. We absolutely have to talk about systemic risk, specifically how really opaque financial engineering basically set the stage for the 2007 housing crash. The sources call this Act Two of the subprime machine.
Yeah, the scale of that boom leading up to the crisis, it's honestly terrifying to look back on, just sheer irresponsible volume. In the year 2000, total subprime mortgage lending was, let's say, manageable, around $130 billion. But by 2005, it had exploded, almost 5 times bigger, reaching $625 billion in a single year. And most of that, $507 billion, was immediately chopped up, packaged, and sold off into mortgage bonds. The velocity, the sheer amount of money moving, it was staggering, especially when you remember interest rates were actually rising then, which should have been a huge red flag.
And the risk wasn't just the volume, it was built into the loans themselves, right? The very structure of mortgages changed dramatically in that period, turning short-term affordability into a ticking time bomb.
Devastatingly so.
Okay.
In the mid-90s, say 1996, about 65% of subprime loans were fixed rate. Your payment stayed the same for 30 years. Predictable. By 2005, that had completely flipped. Now, 75% of new subprime loans were floating rate. Usually they had a low fixed rate for just the first 2 years.
The infamous teaser rates.
Exactly. Once that 2-year teaser period was up, the interest rate would reset, often jumping way higher. Payments could suddenly increase by 30%, even 50%. That built-in payment shock massively increased the odds of widespread defaults once those resets started hitting en masse.
And the key financial products used to package and, frankly, hide all this risk were the CDOs, collateralized debt obligations.
For listeners who maybe aren't steeped in derivative markets, can you break down how CDOs created this dangerous lack of clarity?
Sure. So a CDO is basically a big pool of assets, usually bonds. In this case, those bonds were themselves backed by pools of subprime mortgages, mortgage-backed securities, or MBS. And this big pool of MBS bonds is sliced up into different layers, different pieces. They call them tranches. The basic idea of the sales pitch was diversification. If a few loans default, the rest of the pool absorbs it. But the crucial part was the ranking of these tranches. The top slice, the senior tranche, was usually rated AAA. Supposedly ultra-safe because it gets paid first from the mortgage payments coming in. The lower tranches, mezzanine and equity, took the first losses. But hang on, if the underlying stuff, the actual mortgages, were increasingly shaky subprime loans, how could anyone possibly claim the top tranches were AAA rated? That's the same rating as, like, U.S. government debt.
Well, this is where the market just went completely off the rails. Irrationality, maybe willful ignorance. The rating agencies, who were, by the way, paid by the investment banks creating these CDOs, they were incredibly slow to react to the real default data coming in. They kept using models based on historical default rates, which just didn't apply anymore. And crucially, their models assumed housing prices would keep going up forever, which they didn't. This magical thinking allowed mountains of what was essentially junk debt to be repackaged and stamped AAA. And institutions like pension funds, money market funds, they were often required by their own rules to buy only highly rated debt. So they bought these AAA CDO tranches thinking they were rock solid. No need to look too closely.
And speaking of not looking too closely, the sources have this almost darkly funny description of the CDO managers themselves.
Right. The sort of Wall Street shorthand for the typical CDO manager was apparently 2 guys and a Bloomberg terminal in New Jersey. The perception, according to the sources, was that their main job was just to be a legal entity, a shell company, to hold these assets. Often they were chosen precisely because they weren't likely to dig too deep or ask uncomfortable questions about the quality of the mortgages inside the CDO. The real function of the CDO, as described in this material, was basically to launder the subprime risk that the big banks originated but couldn't sell directly. The less scrutiny from the manager, the better for the banks.
And we saw similar irrationality in the market for insurance on these things, right? The credit default swaps, CDS.
Yes, exactly. CDS is basically insurance against a bond defaulting. And the pricing of this insurance leading up to the crisis is just baffling. It showed a profound lack of understanding, or maybe just disregard, for the actual risk involved. The source material uses a really vivid analogy. It was like buying flood insurance on a house, sitting right in the middle of a known floodplain, for the exact same price as insurance on a house perched safely on top of a mountain. The prices didn't reflect the wildly different probabilities of disaster. The whole system was just riddled with mispriced risk, fueled by massive bonuses, and frankly, a breakdown in basic due diligence. Hashtag tag 2.2, the digital transformation, PropTech.
Okay, so that inherent lack of transparency, that fundamental information imbalance in traditional real estate finance, that seems to be exactly the problem that this current wave of digital transformation, what we call PropTech, is trying to fix.
Yeah, and it's a necessary push because the scale here is just enormous. We're talking about real estate as a, $38 trillion market in the U.S. alone. That sheer size, combined with how opaque it's historically been, has attracted huge amounts of investment into technology. The sources mention it peaked at nearly $18 billion in PropTech venture capital back in 2021. That kind of money is fundamentally changing how property is bought, sold, managed, and valued.
Where are we seeing the biggest impact in terms of injecting more transparency?
Primarily in the commercial real estate world initially. There are new platforms emerging now whose stated goal is to be the Bloomberg terminal for commercial real estate. Systems like VTS, for example. They aim to standardize market data, lease rates, vacancy trends, comparable sales, and centralize all the critical portfolio information for landlords and investors, often called AIMS, Asset Information Management Systems. Before, all that data might live in, 50 different spreadsheets across different departments. Now the idea is to make it standardized, accessible, visible, which inherently increases transparency and hopefully efficiency.
But even with all this digitization, The sources suggest real estate investing still has unique risks compared to, say, buying stocks.
Oh, absolutely. Real estate inherently carries more idiosyncratic risk.
Idiosyncratic risk. Break that down.
It just means risk that's very specific to that particular property or its immediate location. Unlike a stock, which reflects a national or global company, the value of, say, an apartment building in downtown Austin depends heavily on the local Austin economy, the specific neighborhood culture, local zoning laws, even the reputation of the school district down the street. It's hyper-localized. So even with better data tools, you still need deep local knowledge. You can't just apply a broad national analysis.
And when we apply this kind of data-driven approach to managing cities themselves, we get into smart city technologies. What are the implications there?
Well, the promise of digitizing city planning with smart city tech is huge, right? More efficient traffic, smarter energy grids, better public services, maybe higher productivity overall. But there's a predictable side effect. When you use this technology to measure and identify opportunities for improvement, especially in previously overlooked or blighted neighborhoods.
You basically put a giant spotlight on them for investors.
Exactly. Data reveals undervaluation. Capital follows data. So applying smart city tech to improve these areas almost guarantees it will accelerate gentrification. You'll likely see higher property values, which is good for existing owners, but also displacement pressure on lower-income residents. Technology tends to amplify these economic sorting mechanisms.
Now, this drive towards transparency and centralized data via PropTech, it stands in pretty stark contrast to some other perspectives present in the source materials you were given. We have an obligation here to report on the full spectrum of the content provided, so we need to address some highly controversial, and let me stress, non-endorsed views that appear in your sources regarding institutional control and public trust.
That's correct, and it's really crucial for you listening to understand. We are simply relaying the content and nature of the materials provided for this deep dive. We are not validating, verifying, or endorsing these specific viewpoints in any way. These particular sources offer some very strong commentary on what they see as widespread institutional control, manipulation, and the methods used to enforce compliance.
Okay. Specifically, some of the material touches on quite sensitive topics. Allegations about a global medical hierarchy, claims of large-scale deception.
Yes. For instance, these sources include anecdotes presented as fact. One example given is a claim about a nurse allegedly being told by management to essentially put up, shut up, and get it done regarding administering vaccines. The material claims the nurse was told the government was leaning heavily on NHS management. The source then uses this specific claimed interaction to argue that this is illustrative of how a supposed global medical hierarchy operates by using top-down pressure to enforce compliance, overriding individual concerns or objections.
The materials also deploy some very specific, almost symbolic language to describe this system of perceived control.
They do. One term used is the wetico-perceptual combination of psychopathic enforcers and weak and meek, unquestioning compliance. That term, wetico, is used to suggest a kind of cultural or psychological infection they believe is at play. Furthermore, these sources explicitly state that the global smart grid, which encompasses technologies like the digital city planning we just discussed in PropTech, is, in their view, actually the Wetico grid. They claim it's a crucial component of what they call an alleged cult endgame.
And beyond that, there's specific commentary questioning mainstream narratives around recent global health events.
Yes. The sources include direct claims questioning, for example, the need to, quote, scam cases and deaths, if, in their words, a real virus existed. They also raise questions about why, after initial reports, there weren't allegedly mass deaths in Wuhan, claiming this contradicts early propaganda. These viewpoints, which also include specific assertions that high-profile figures like Elon Musk are actually serving cult interests by enabling compliance, these are all present in the provided source material. We are presenting them here solely to give you the full picture of the information stack we were asked to analyze, relating to themes of institutional power and perceived manipulation. Again, this is not an endorsement.
Right, let's shift focus now, moving away from the really big macro picture of policy and global finance down to the micro level, the boots-on-the-ground world of the real estate investor. The core strategy often gets boiled down, maybe oversimplified, right? Buy for cash or invest for cash flow and equity over time.
That's the basic framework, sure. But where the real skill comes in, where the value is truly created, isn't just the broad strategy, it's in defining the transaction. The sources make a really important distinction here. They say criteria define an opportunity. I'm looking for a 3-bedroom house in this school district. but it's the terms, the actual price, the down payment amount, the interest rate if there's financing, the closing date. Those are what define how you turn that opportunity into a great deal. Mastering the negotiation of those terms is where you make your money.
And the very first step in getting favorable terms often involves understanding the seller's mindset, their psychology, which is why that classic simple question is apparently still so powerful. So why are you selling us a nice place?
Oh, that question is absolute gold. Because you're not just asking about the property features, you're probing for motivation. Motivation reveals urgency. Urgency gives you leverage in the negotiation. One key signal, according to the sources, how much the sellers come down from their initial asking price right away. If they make a big drop quickly, that signals they're probably eager to sell fast.
Which tells the savvy buyer.
It tells the buyer to then respond with small incremental increases in their subsequent offers. You preserve your capital, don't leave money on the table, but still move towards closing the deal. The whole game is figuring out, is the seller's need to sell now greater than their desire to squeeze out every last possible dollar? If yes, you have leverage on terms.
Now, for investors who are maybe just starting out or operating with less capital, finding ways to close deals without needing huge cash reserves is obviously key. This brings us to creative buying strategies.
Right. And creative buying often revolves around finding properties with deferred maintenance, houses that need work. You can use those specific necessary repairs like it needs a new roof, the AC units are shot, maybe there are foundation issues. You use the cost of those repairs as direct leverage to negotiate a purchase price significantly below the market value of a comparable fixed-up house.
The repair estimate becomes your negotiation ammo.
Exactly. And in really low-capital situations, what are the go-to tactics?
The sources point heavily towards seller financing.
That's paramount. If you can get the seller to essentially act as the bank for you, even for a short period, you completely bypass the traditional mortgage hurdles. That's huge. Another really powerful tool mentioned is the lease option contract. The sources give a great example. A buyer puts down a relatively small option fee, maybe just $1,000. Then they lease the property while actively doing rehab work on it. After, say, 6 months or a year, the property's fixed up, looks great, and it appraises for a much higher value. Now the buyer can go get conventional financing based on that new, higher appraisal value. They effectively pull out equity they created with sweat, using minimal upfront cash.
But pulling off these creative deals requires serious negotiation skill. It goes beyond just haggling over price, right? It gets into managing the relationship, understanding the other person. Tactical empathy comes up.
Tactical empathy is highlighted as a massive tool in the sources. It's about genuinely recognizing and then verbally acknowledging the other person's perspective, their feelings, their position. Even if you completely disagree with it, you're essentially labeling their emotion. Like, think about that classic trope of the car salesman who pretends he has to go battle his manager to get you a better price.
Right, he's acting like he's on your side against the system.
Exactly. He's acknowledging your desire for fairness, your feeling that the price might be too high. That instantly makes you feel more collaborative with him.
Yeah.
Or a negotiator who says something like, it sounds like you feel that initial offer was disrespectful. Just saying that, acknowledging their feeling, can make the other side dramatically more open to listening to your next proposal.
And what about when you're faced with a demand that's just completely unreasonable? Instead of hitting back with a hard no, which can escalate things, the technique suggested is the gentle no, using how questions.
Yeah, the word no tends to shut down conversation. It creates conflict. But asking a calibrated how question, like, okay, I understand you want that price, but how can we possibly justify paying that much given the significant foundation repairs needed? It does a few things. It elegantly signals you can't meet the demand, but without being confrontational. And crucially, it invites collaboration. It subtly forces the other person to start thinking about your constraints and problem solving with you. Often it guides them towards suggesting a compromise themselves, ideally one closer to what you wanted anyway, while letting them feel like they weren't just shut down. It preserves the relationship and their sense of agency. Hashtag 3.2 property management and value maximization.
Okay, so you've negotiated the deal, you've closed. Now the focus shifts to actually running the property, maximizing its value as a rental, and minimizing long-term headaches and costs. The sources emphasize you don't always need huge capital projects to significantly boost the rent you can charge, the average rental value, or ARV.
Right, these are the upgrade hacks. Smart, relatively low-cost improvements that have an outsized impact on how rentable the unit is and how durable it is over time. Flooring is a great example they use. Cheap carpet gets trashed quickly, constant replacement hassle, and cost. Natural hardwood looks beautiful but scratches easily, sensitive to water, high maintenance. Laminate flooring often hits that sweet spot. It looks decent, it's relatively easy to install, it's incredibly durable, resistant to spills and wear and tear. Choosing durable laminate might cost a bit more upfront than carpet, but it can justify higher rent and dramatically cuts down on turnover costs and vacancy time later.
But perhaps the most critical factor, and one often overlooked by new landlords, isn't the physical property as much the management of the people living in it. Tenant management. Training your tenants, essentially.
This is absolutely non-negotiable for long-term success, according to the sources. It sounds maybe a little harsh, training tenants, but it's about setting clear expectations from day one. If a property manager lets a tenant slide on rent, pays a day late the first month, the sources say they'll pay 3 days late the next month, and pretty soon they're consistently behind. You've inadvertently trained them that the due date is merely a suggestion. It is absolutely critical to strictly enforce on-time rent payments, and also to address other lease violations like unauthorized pets or extra people moving in promptly and firmly, always referencing the signed contract. You have to be fair, operate within the law, but you must be firm in enforcing the agreement to protect the asset's financial performance.
A lot of landlords seem hesitant to raise rents regularly, maybe fearing tenants will move out, but the sources argue strongly against underpricing units.
They really do, because the reality is tenants generally expect a modest rent increase each year. It's just the nature of the rental market. Inflation happens, costs go up. The sources issue a pretty stark warning here. If you underprice your unit by just $50 a month compared to the market rate, that's $600 per year in lost income for that one unit. Multiply that across a portfolio. It adds up incredibly fast. In almost all cases, the accumulated lost revenue from chronically underpricing units far exceeds the occasional cost of turning over a unit when a tenant leaves due to a fair market rate increase. You have to price based on the market, not based on fear of vacancy.
And one last crucial point on the management acquisition side, especially for investors buying into condos or communities with homeowners associations.
Oh yeah, the due diligence landmine. This is the rookie mistake that can absolutely sink an investment before it even starts. You must, absolutely must, obtain and thoroughly review the HOA's CC&Rs, the covenants, conditions, and restrictions before you close the deal. Failing to do this can lead to the nightmare scenario where you buy a property intending to rent it out, only to discover after closing that the HOA rules explicitly forbid rentals altogether or have severe restrictions like minimum lease terms or rental caps that kill your strategy. This traps the investor. Might force a quick sale at a loss. It underscores that legal due diligence, reading the fine print, is every bit as important as running the financial numbers.
Okay, we've covered the big picture policy, the complex finance, the negotiation tactics, but ultimately long-term success in anything, especially something as demanding as real estate investing, seems to come down to consistent personal action, execution. This brings us into behavioral science territory, the habit loop.
Yeah, habits are really just the brain's way of saving energy. They're automatic solutions for recurring situations or problems. So if you want to build positive new habits like consistently analyzing potential deals every morning or making follow-up calls, the sources say you need to leverage 3 basic laws of behavior change.
Okay, law number 1, make it obvious.
Make it obvious. This is about removing ambiguity, making the cue for the habit super clear. The best way to do this is using what are called implementation intentions. These are specific plans for when and where you'll perform the habit. Not just I'll analyze deals, but when I finish my first cup of coffee each morning, I will immediately open my analysis spreadsheet at my desk. Very specific cues.
Got it. Second law, make it attractive.
Make it attractive. We're wired to move towards pleasure and reward. So you need to link the habit you need to do with something you want to do. This is often done through temptation bundling. For example, I will only allow myself to listen to my favorite podcast while I'm doing my property expense reconciliation. The reward is tied directly to performing the task.
Makes sense. And the third law, make it easy.
Make it easy. If a habit requires a lot of willpower or effort, especially at the start, your brain will likely choose the path of least resistance and skip it. So you need to reduce friction, like lay out your workout clothes the night before, or for real estate, maybe prep your list of leads the evening before you make calls. And also, use the 2-minute rule. This is powerful. You downscale the habit until it takes 2 minutes or less to start. Want to read more? Commit to reading just 1 page. Want to analyze deals? Commit to just opening the file. The goal is just to make starting the action incredibly easy. Because often just getting started is like 80% of the battle. Once you start, momentum often carries you.
For really ambitious people, a common pitfall mentioned is trying to do too much at once, spreading themselves too thin with annual goals. The sources advocate for a much shorter, more intense focus, 12-week planning cycles.
Yeah, the 12-week year concept. It's designed to create urgency and intense focus. Instead of having, say, 10 big goals for the entire year, which allows for procrastination, you identify the top one, maybe two or three key objectives that will have the biggest impact. And you focus almost exclusively on those for just a 12-week period, like a sprint. This hyper-focus helps prevent burnout from juggling too many things. And crucially, the main thing you measure week to week isn't just the end result, like, did I close the deal? Because that has external factors. The key metric is your execution score. Did you actually do the specific actions you plan to do each week to move towards that goal? You control your actions. The execution score holds you accountable to taking those actions consistently.
And that word accountability comes up again and again. The sources suggest that without it, even the best intentions and plans tend to fizzle out.
It seems to be the silent killer of progress. Accountability, in this context, isn't about blame. It's simply about acknowledging your role in the outcomes you're getting, owning it. The sources cite a pretty sobering statistic, actually, that the vast majority of people who read business books or attend seminars, they fail to actually implement the key lessons. Why? Because typically, nobody's holding them accountable. They don't have a coach, a mentor, an accountability partner, or even just a structured process to report back to. That external oversight, that expectation, seems critical for forcing consistent action.
And for people specifically in sales roles, like acquiring properties or finding investors, this internal drive, this bias towards action, is described as initiative.
Initiative is framed as almost a magical cure-all elixir for salespeople who feel stuck or in a slump. When you hit a wall, the answer isn't to wait until you feel motivated. The answer is always to take action. Any action. Pick up the phone, send one more email, schedule a coffee meeting, follow up on an old lead. Action breeds motivation, not the other way around, and persistence is key too. This isn't about being pushy, but about consistently, gently reminding a potential client or seller why your offer or service is the right fit for them, especially when they enter what the sources call the fear stage, that moment of hesitation before a big decision. Your calm, persistent follow-up can help get them across the finish line. Hashtag 4.2, building financial frameworks.
Okay, let's bring this back to the financial nuts and bolts that underpin everything. Personal discipline is great, but you need the financial framework too. For anyone seeking loans, especially mortgages, the absolute gatekeeper metric lenders look at is the DTI ratio, debt to income.
DTI is king. It's the single biggest number lenders use to gauge your risk level, how likely you are to actually pay back the loan. It's a pretty simple calculation. You add up all your monthly debt payments, mortgage or rent, car loans, student loans, minimum credit card payments, everything, and you divide that total by your gross monthly income, your income before taxes. The lower that percentage is, the safer you look to a lender. While the math is easy, its impact is huge. It directly determines how much you can borrow. So actively managing and lowering your DTI is probably the fastest way to increase your borrowing capacity.
Beyond just getting loans, smart investors think long-term about tax strategy. And the sources highlight a basic choice when it comes to retirement savings vehicles and how they're taxed.
Yeah, it's often described as the choice between jam today or jam tomorrow. A traditional IRA or 401k gives you jam today. You get a tax deduction now for the money you contribute. It lowers your taxable income in the present. But you'll pay income taxes on the money when you withdraw it in retirement. A Roth IRA or Roth 401k offers jam tomorrow. You contribute money you've already paid taxes on, no upfront deduction, but all the investment growth and all your withdrawals in retirement are completely tax-free. The choice really depends on whether you think you're in a higher tax bracket now or if you expect to be in retirement. And importantly, for real estate investors, the sources note you can often use self-directed 401k or IRA plans to invest directly in real estate assets, allowing rental income and appreciation inside that retirement account to grow tax-deferred or tax-free, depending on the account type.
And there's a specific tax rule about selling rental properties at a loss that investors really need to know about. It's quite favorable.
Yes, understanding the difference between an ordinary loss and a capital loss is huge here. Generally, when you sell a rental property for less than you have invested in it, your basis, that loss is usually considered an ordinary loss by the IRS, assuming you meet certain activity requirements showing you actively participated in the rental business. Why does this matter? Because capital losses, like from selling stocks at a loss, have strict annual limits on how much you can use to offset your regular income, usually just $3,000 per year against ordinary income. But an ordinary loss from selling a rental property, it generally has no annual limit on how much can be used to offset your other ordinary income, like salary or business income. This can create a massive tax shield in the year you sell a property at a loss.
We also can't forget the sheer mathematical power of compounding returns over the long haul. It's fundamental to wealth building.
Compounding is like magic, but it's just math. It's the engine of building real generational wealth. The sources illustrate this really clearly. Even seemingly small differences in your average annual rate of return make an exponential difference over long periods. For instance, they show how doubling your consistent return from, say, 5% per year to 10% per year over a 40-year investment horizon doesn't just double your money, it can result in more than 6 times the total final amount. That's why sophisticated investors obsess over optimizing their returns even by fractions of a percent, because over decades, those small differences become enormous gaps in wealth.
Lastly, when large commercial investors are evaluating a big potential property deal, how do they move beyond just simple back-of-the-envelope cash flow estimates to make objective decisions?
They rely on more sophisticated financial metrics, things like cash-on-cash return, which measures annual cash flow against the actual cash invested. Also, the internal rate of return, or IRR, which calculates the effective annualized rate of return the investment is expected to generate over its entire holding period. But perhaps the most rigorous metric, often preferred for major commercial decisions according to the sources, is net present value, or NPV.
Okay, and NPV, what makes that different or superior?
NPV incorporates a crucial concept: the discount rate. The discount rate represents your opportunity cost. What rate of return could you reasonably expect to earn if you invested your capital in something else with similar risk? Maybe the stock market or another real estate project. NPV takes all the projected future cash flows from the property, all the expected rental income, minus expenses, plus the expected sale price at the end, and it discounts each of those future dollars back to what they are worth today, using that discount rate. If the sum of all those discounted future cash flows minus your initial investment today results in a positive number, a positive NPV, it means the project is expected to generate returns greater than your opportunity cost. It's financially worthwhile. If the NPV is 0, it meets your required return exactly. If it's negative, the analysis says you'd be better off putting your money in that alternative investment represented by your discount rate. Walk away. Hashtag tag outro down.
Wow. Okay, this deep dive has really covered a vast territory. We went from systemic injustice baked into mid-century housing policies and zoning, through the dizzying complexities of global financial risk and CDOs, right down to the nitty-gritty psychology of negotiating a deal or even building personal habits.
It really has. And I think the biggest takeaway, the thread connecting all of it, is that real success in finance, and especially in real estate, requires this kind of dual vision. You have to be able to see the world through a macro lens, understanding policy, power structures, systemic risks, and simultaneously through a micro lens, mastering your own execution, your negotiation skills, your financial discipline. The two are completely intertwined. You can't succeed long-term by only focusing on one.
And, as we discussed, this PropTech revolution, this wave of digitization, is pushing the real estate world towards a level of transparency it's never had before. Historically, a lot of successful investing, as the sources mentioned using the term Downhill arbitrage spreads, relied on exploiting information imbalances, knowing something the other guy didn't.
Right. Those arbitrage spreads, those gaps created by information asymmetry, they're shrinking fast. As technology makes data cheaper, more standardized, more accessible, think of that commercial Bloomberg terminal idea. If the market truly is becoming radically more efficient, if information becomes almost perfectly symmetrical, then those old ways of finding an edge, of capitalizing on hidden information, they start to disappear.
Which leaves us with a really provocative question for the future, doesn't it?
It does. For you listening, think about this. If the easy information arbitrage is gone, what are the next forms of arbitrage? What new, more subtle imbalances or inefficiencies must the next generation of successful investors learn to identify and exploit? Will it be behavioral arbitrage understanding psychological biases better than others? Regulatory arbitrage navigating complex rules more deftly, maybe even psychological arbitrage within negotiations? What's the next hidden edge before the market eventually catches up and makes that transparent too? Feels like a constant race to find the next inefficiency.